The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning and a warm welcome to Squawk Box Europe. I'm Juliana Tattlebaum with Karen Show, and these are your headlines. Equity markets rally as investors look beyond tariffs and weak economic data to the prospect of further rate cuts from the Fed, with markets poised for further gains today.
President Trump threatens to ramp up tariffs against India over its Russian gas purchases, but New Delhi says it's just protecting its own interests. We'll hear from the US president later today. Infineon raises its full-year margin outlook, with CFO Sven Schneider telling CNBC the impact from tariffs will be less than expected.
We think it's less pronounced than we originally thought, and therefore we see also some growth momentum in the current quarter coming in.
Good morning. Numbers are just crossing from BP this morning, so let's just dive into the latest detail. The BP Q2 net income line has hit the tape this morning, and first up to that number as we see the numbers cross 1.62 billion. The number on cash flow, operating cash flow, 6.27 billion, net debt tallying up to 26 billion. The dividend has hit at 0.08 USD this morning, and net income 2.35. This is the adjusted line, adjusted net income of 2.35 billion versus estimates of 1.8. So we're topping that expectation well and truly to the market today. In terms of the dividend per share, we've got 8.32 cents for 2025 is the level per ordinary share. The company, in addition, announcing a $750 million share buyback for this year. Proceeds from completed or announced divestments have reached around $3 billion for the year. And cost reductions, just a quick line on that, $1.7 billion of structural cost reductions since the start of their program. And let's get into the detail with Murray Auchincloss, who is the CEO of BP. Murray, thank you so much for joining us today. A lot of mixed news flow coming up to the earnings today as they hit the tape, the pressure on cutting costs, but also news of a massive discovery potentially off the coast of Brazil. Do you want to start with that? Because it goes to the heart of the growth strategy, perhaps.
Well, first, thanks very much for having me. And it was a good quarter, as you said, 2.4 billion of earnings, 6.3 billion of cash flow. We've announced a 4% dividend increase, and of course, another 750 million of buybacks for the third quarter. As you say, inside the upstream, we've had tremendous performance, along with record operating efficiency, along with starting up 5 new major projects. We've had tremendous exploration success, 10 commercial exploration discoveries so far this year. And yesterday we announced our most exciting, the Bumerangue discovery in Brazil, where we've discovered a hydrocarbon column that's 500 meters high and over 300 kilometers wide. We've done sampling on the rigs, and we're sending the results into the lab. But we're very optimistic. This is the largest discovery for BP in 25 years.
Murray, is there some irony in that? Because there's a lot of pressure from activists to cut back, to be very, very fixed on those costs. But if you're too strict on cost cutting and on capex, then you don't get discoveries like that. Is there a lesson in this enormous discovery?
Well, I think investment discipline is very good for all seasons. So we have a tight capital frame, 13 to 15 billion. We're constantly trying to drive efficiency inside that. We have a big cost program where we're trying to reduce our costs by 4 to 5 billion. We've had a very good start 2 quarters in. We've delivered 1.7 billion of structural cost reductions, as you said. And so all of those things are equally important. But as you say, you can't go too far. Our job is to safely grow the business, and you need to continue to invest to grow. And we're so pleased with the 10 exploration discoveries, and especially the discovery in Brazil.
Murray, to the point around cost, then we've just seen this line hitting the tape this morning that you're initiating a further cost review. Just walk us through that and what that will entail.
Yeah, so we have a plan. So if you think back to 2020, we reduced our cost by 25%. And in 2024, we announced another program to reduce our cost by another 20%. That's the 4 to 5 billion I referenced earlier. If we can achieve that, that'll take us to around top quartile in our sector. But I don't think that's enough. We need to keep driving safely to be the very best in the sector we can be. And that's why we're focused on another review to try to drive us towards best in class inside the sector. And technology plays a huge part in that. Just technology is moving so fast, we see tremendous opportunity in that space. So it's good for all seasons to drive cost discipline and capital discipline into the business, and that's what we're focused on.
Marie, in addition to a review of your cost structure, you're also saying today that Albert Manifold, the incoming chairman, joining the board September 1st, that you and he have been in discussions and have agreed that we will conduct a thorough review of our portfolio of businesses. What is on the table here when it comes to your portfolio assessment, when it comes to divestments? How could we see the portfolio change?
Yeah, first, I'm super excited to get Albert on board as our chair. He's got fantastic track record of delivery, 10 years with CRH, a big industrial company that performed top of the sector. So I'm super excited that Albert's joining us and look forward to working with him. I think on portfolio, look, we've had more success than we thought we could have. We've had access in Azerbaijan, in Iraq, in Abu Dhabi, in Libya. And then we've had these 10 exploration successes as well. You don't really plan on that basis. So it's time to take a think about how we drive the highest value and returns for the company by choosing which things we move forward. And that's what the portfolio review about is, just taking a pause given the exceptional success we've had and thinking about how we drive more value and accelerate the strategy for the company.
Could we see more divestments, more than you had initially envisioned?
We have a big program of divestments already announced, a $20 billion divestment package. We're well underway, 3 already announced, as you said in the opening, and we continue to work on some other ones as well. We feel very confident in the $20 billion. I think the portfolio review, you'll think about farm downs, you'll think about timing of investment, final investment decisions, et cetera. But that's what we're focused on, and we'll move through that review.
Marie, it's very public knowledge that you were facing pressure from some of your shareholders, notably Elliott Management. They've been pushing for more cost cutting here. Your share price has been under pressure relative certainly to your U.S. peers. And you told us back in April when we spoke to you that you were a strong, independent company with sector-leading growth. Since then, there have been reports that bidders have been swirling around BP, running the numbers on what a takeover could look like. Can you comment on whether you have been approached by suitors and what your stance is at this moment when it comes to BP potentially participating in M&A?
Look, we have a great growth program ahead of us, as you said, from 24 to 27. We plan to grow our cash flows from $8 billion to $14 billion. That's 20% compound annual growth. We're well underway. We've had a 40% improvement, 1H24 to 1H25, so we feel very good about our progress in that space, given the underlying operating efficiency. And we keep moving forward. That's what we're focused on, is growing. That's what's going to drive share price up for shareholders.
When you spoke to us back in April, you were asked by our colleague Steve whether you would consider asking for protection from the British government to keep bidders away. Has your response changed at all?
No, we just continue to focus on growing cash flows, and that's what we're focused on.
Murray, can I just come back to the numbers? A beat on a number of the different lines today, all that coming amid enormous oil price volatility in the latest quarter, that Liberation Day free fall that we saw in markets, and of course a spike again around the Middle East tensions. Just how did that play out from your view in terms of some of that volatility? So first I should congratulate the trading teams for managing their way through all the volatility. Our gas business had an average quarter, is what we call it, and our oil trading business had a strong quarter. They did a very good job in April and May working their way through all the volatility that was happening in the external world, clipping profits as they went. So really it was about shortening the cycle time on the trading window, and they did a very good job working their way through that. The reality is we're not done yet when it comes to some of the potential macro volatility as we waited up for some of the tariffs to land and others still yet to be negotiated. What does the demand picture look like to you for the product at this point? Yeah, I think we're seeing in-line demand growth with what we've seen in the past. So about 1% growth over the past 20 years on average. This year we're seeing 1%. Next year we're seeing 1%. It comes from different places. It comes more from the petchem side of the demand profile right now.
but we see demand in line with history, to be honest, despite all the headlines. And of course, there's additional supply coming onto the market, but we think that demand and that supply from non-OPEC countries pretty much offsets each other, and therefore oil price will be up to OPEC Plus to decide where it goes, and then we'll just have to see how sanctions on Russia and sanctions on Iran play into that as well.
How much influence do you think the White House, in particular the US president, is having on the oil market from here? Seems to want to have oil prices lower, but there's still a ton of tension on geopolitics and trade tariffs really coming from the White House.
We work closely with the U.S. administration on growing our business in the United States. We've got big plans to grow our production about 10% per year out through the end of the decade, both in the Gulf of America and in the lower 48. Tariffs haven't really impacted us across the totality of the business, and regulations getting easier. So we find constructive relationships, and we just work our way through. We work our way through the headlines, and things just continue to improve.
Murray, thank you for taking the questions and joining us on Back of Numbers. We do appreciate it. Murray Auchincloss with us, the CEO of BP.
Let's turn our attention now to Diageo. We've just got earnings through from the world's biggest spirits maker. In terms of the numbers, they have recorded full year sales of $20.245 billion, $20 billion versus estimates of 20.794, so slightly weaker than expected. In terms of operating profit, that's come in at $4.335 billion. We are increasing our cost savings target by $125 million to $625 million over the next 3 years. In terms of the guidance here for fiscal 2026, organic operating profit growth to be mid-single digit, including the impact of tariffs at this time. So we're looking at organic sales growth to be similar for fiscal 2026 to fiscal 2025, including the impact of U.S. tariffs, and the company raising its cost savings target to $625 million. Clearly, this has been an industry that has been suffering from a softening demand here. They're under major pressure to initiate efficiency and savings where they can, and this is part of why Diageo has increased its cost savings target to $625 million. In terms of CapEx in fiscal 2026, it's expected to be lower than spend in 2025 in the range of $1.2 to $1.3 billion. So again, looking to save where it can. In terms of the impact of tariffs, the company is actually putting a number on it. The unmitigated impact of tariffs is estimated to be $200 million on an annualized basis. And that's, of course, at the current levels based on what they know. So putting a number on it, which is a brave thing to do in the current environment, but we're seeing more and more companies do it over the last couple of weeks as we do have some clarity on where things are landing.
The company really talking about becoming more nimble at this point, a very challenging environment out there, and how it just keeps on changing. Obviously some standouts in the brand. Interesting to see the standout performance from Don Julio. So tequila still performing for them. Guinness was strong, and Crown Royal Blackberry was another one they called out in terms of the top brands, but meaningful growth is what they're hoping for here in the evolving landscape. And I think that's fascinating because you've seen a lot of reshaping of portfolios from the entire sector, not just Diageo in recent times, but when it comes to this company specifically, the fact that the CEO departed recently, and we have almost a holding pattern until they decide whether the interim remains or whether they recruit elsewhere. I think that is going to be something that we're going to see, whether they can step up their game in what is an industry that really is in a state of flux thanks to some of the tariffs and changing habits of consumers. So taking out some of the spending habits and trying to get to high cost savings, what the target 125 to 625 million. It's a fairly big step up that they've gone for in terms of those savings.
And clearly they're under pressure from shareholders, and we've got a great guest coming up who from Goodbody, who looks at this space in more detail. And I think one of the big questions is to what extent Diageo's problems are company specific or industry wide, given the slowdown that we've seen, especially in the U.S., has hit drink makers across the sector. It seems to be more of a structural industry wide problem.
Yeah, and looking at the volume and price mix level, I mean, there was a time and a place when it was really during the COVID era that every time we broke numbers, that volume growth and price number was fairly high, and that was not just in drinks, it was also in food. But to see the volume number at 0.9 and the price mix 0.8. It's really come off the highs, hasn't it?
It certainly has. Well, let's take a look at U.S. markets. We saw a pretty amazing rally yesterday. Investors swooping in to buy the dip after the sell-off on Friday. So we had strong gains across the board in the U.S. The tech-heavy NASDAQ gaining 1.95%. It was actually the best daily performance for that tech-heavy index since late May. The Dow Jones, meanwhile, broke a 5-day losing streak. The S&P 500 added about 1.5% as well. So strong across the board. That positive sentiment has spread to Asia overnight, where markets are generally higher. You've got the Kospi over in South Korea leading the gains up 1.6%, but decent gains as well for the Japanese, Hong Kong, and Shanghai markets. What about Europe? Let's take a look at what's in store for the European market open. We saw a bounce back yesterday. Stock 600 gained 0.9%, breaking a 3-day losing streak. So again, investors buying the dip after the selling on Friday. Now this morning, those gains set to continue as investors digest more earnings from European corporates. As for U.S. futures, here's the early indication. You've got muted but green start indicated. Wall Street called higher at this early hour. We're looking at the Dow adding about 70 points at this stage. U.S. President Donald Trump is going to be speaking on Squawk Box U.S. later today. You can tune in to his interview at 1 p.m. BST with our U.S. colleagues.
Coming up on this show, a fresh warning for India as President Trump threatens to substantially raise tariffs over its imports of Russian oil. Plus, Infineon forecasts further growth in the current quarter. Despite ongoing uncertainties over tariffs, we'll get more from the CEO this hour. And Fresenius Medical Care misses on second quarter earnings. We'll hear from the CEO, Helen Giza. That is coming up next.
Welcome back to the program. Fresenius Medical Care posted second quarter results that fell short of market expectations, citing elevated mortality and a severe flu season. The German firm confirmed its full year guidance, though, after sales and profit both rose. Helen Giza joins us now, CEO of Fresenius Medical Care. Helen, very good morning to you. You characterized the quarter for us. How did things go, and what are you thinking for the second half of the year?
Yeah, good morning, and thank you for having me. Look, we were really happy with the development in the quarter, and the quarter did develop in line with our expectations. We do always see a lower first half than back half, and as you just said, we have confirmed our full year guidance and kept the range as we've seen it, that we printed at the beginning of the year. For the quarter itself, we obviously saw 7% organic revenue growth, which was great across all segments, and a 13% growth in OI. So really strong performance, which really tells us our transformation and turnaround and operational improvements are working. The one metric that we watch closely is same market treatment growth in the US. And that was flat for the quarter. Obviously, we had a heavy flu season this year. And for us, without patients, if we lose patients to mistreatments or to mortality due to flu, that compounds as we go through the year. So while we are really encouraged by the new patient starts and improving referrals on the inflows, the outflows were affected by that higher flu season, which has kind of caused a dampness on the same market treatment growth in the quarter. But overall, margin progression across our care delivery business and our care enablement business, which developed exactly as we had planned.
Can you give us a little bit more color into what's happening in the U.S.? Certainly appreciate the impact of the more severe than usual flu season and what that means. Mm-hmm. But outside of that factor, how would you characterize demand in the United States?
Yeah, I mean, look, as we've continued to recover our patient volume post-COVID, we have definitely seen this softness in patient volume. We had 300 basis points hit from patient growth at the peak of COVID, and now we are posting flat same market treatment growth. As I mentioned, what's really important is seeing these new patients coming in. So what we refer to as referrals, the new patient starts, that has improved sequentially for 5 months in a row now. So that's the really important underlying metric. Outside the flu season, which will normalize, the inflow of patients, that is improving. And that's what we're really encouraged by.
Helen, there's been a ton of tariff uncertainty and pharmaceuticals at this stage seemingly exempt, but there could still be something coming. What does that mean in terms of the influence on the cost base and the type of pharmaceutical drugs that you can be offering to patients?
Yeah, so overall, as we kind of size the tariff impact, we continue to see rather limited impact for us. A lot of our products are under exemptions because of the nature of our products as well as our patient base. We have a huge manufacturing base in the U.S., so that obviously protects a lot of our kind of our U.S. cost base. Where we are importing, and that's mainly machines, they do have the right exemptions and tariff low tariff impact. Obviously, on pharmaceuticals, we're watching that closely to see how that develops. But right now, we don't see any impact on that through 2025.
If there were to be a change on pharmaceuticals, what would that mean, though, in terms of where it would land on the business?
Yeah, through 2025, we feel pretty good with where we are with the supply chain. I think, we are looking at the renal pharmaceuticals that we do import and what that could mean. I think too soon to say what impact that could be, but it's more medium term, not immediate term, I would say. But obviously, we've got to see where the country percentages land, and depending on what we're importing from where.
As we talk about tariffs, obviously one of the implications has been whether they could be inflationary or not. Looking through some of the numbers today in care delivery, I can see that you talk about higher personnel costs due to some merit increases and also unfavorable medical benefit costs here. Other inflationary cost increases coming into the mix too. Just unpick that for us. What does inflation look like today in the business versus a couple of years back?
Yeah, I feel like our regular labor merit costs are under control at that 2 to 3% net. Obviously, we watch where we might need to pay particular attention in particular hotspots in the US. But overall, I would say the base inflation and merit increase are under control. What was a surprise in this quarter was really the higher medical benefit costs. What we are seeing, and maybe consistent with what we're seeing across some of the insurance companies, are higher claims by our employees and higher cost of claims. So we did see an unfavorable phasing on that through half one. And I think that's something that, all employers who have these self-insured plans are looking at closely with the rising cost of healthcare and the benefit costs provided to employees.
Helen, speaking about the rising cost of healthcare, President Trump has asked the major pharma companies to cut drug pricing in the U.S. to bring down the medical costs for consumers. Talk to us about what that could mean for Fresenius Medical if we see the administration force pharma companies to cut their drug prices. How should we think about the ripple impact on your business?
Yeah, I mean, for us, it would be on if it has any impact on the branded price of renal pharmaceuticals that are being used in our clinics. Today, there is quite a blend of generic and branded products being used. So I think depends on the utilization of whether it's branded or generic, where the product is coming from, and ultimately if there will be price reductions. At the end of the day, those price reductions are real. It can flow through favorable into the cost of dialysis, but could be unfavorable in our pharmaceutical business.
Helen, tech is promising big in terms of disrupting healthcare delivery. What are you witnessing so far that could have a fairly significant impact on the cost base, but also the improvement of healthcare for patients?
Yeah, look, for us, we participate in managing healthcare costs in a number of ways. In terms of tech in our clinics, obviously, we're operating with large-scale systems and electronic health record systems, and that obviously helps efficiency and automation. And we're continuing to make improvements there to drive a much more, drive the efficiencies that we need to see in the clinic footprint. We also have a value-based care business, and our ability to use that data from hundreds of thousands of patients to be able to use algorithms to really see how we can improve those patient outcomes through reduced hospitalizations and reduced mistreatments. So obviously the data and analytics part of our business is key as we kind of take on take on the risk for managing those patients, but also how we effectively manage them through our operations as well.
Helen, let's wrap up on your capital allocation framework. What is your message to shareholders around your commitment to returning excess capital to them?
Yeah, we're very focused on value creation and shareholder returns. The new capital allocation strategy that we rolled out as part of our Reignite strategy at Capital Markets Day in June clearly focuses on that. We're going to invest in growth. We're going to invest in our core. We have, kind of a refined dividend policy that will return 30 to 40% to our shareholders. And after that, the excess will be returned in the form of share buybacks. And what you saw today is that we're already ready to initiate the first tranche of share buybacks in August already. So very committed to value creation and shareholder returns.